another session with Investing Education Academy. And you all have sent us your questions. And as we said before, if you send us your questions, we'll do our best to answer them. And the question came in, what in the heck is a recession? And how will it affect my portfolio? And then again, another thought was, what do we start to do to prepare for the recession if it comes? More likely it will. So before I tell you the reason why we chose that topic, Leon's going to give you that overview while I do a little bit of housekeeping.
Yes. So, I guess to answer the first question, what is a recession? So there's actually a textbook definition of a recession, and I'm gonna go one step beyond that, one step before that, to give kind of build on what actually a recession is. So there's something called GDP. GDP stands for Gross Domestic Product. And all that, it's a fancy word. That all that means is the amount of goods and services that are produced in the U.S. economy. And so put that aside. So just remember that GDP is defined as the amount of goods and services that are produced in the U.S. economy. Now, what is a recession? Well, a recession, all a recession is, the definition of a recession is two sequential or back-to-back quarters of negative GDP growth. GDP growth. Now, for example, let's say in Q1 of this year, GDP growth was 3%, right? And let's say in quarter two, GDP growth was 2%. Now, what happened there? That they right there, quarter to quarter sequentially, GDP growth was negative. It went from 3% to 2%. So that's a negative 1% growth, right? So that's remember, definition of recession is two consecutive quarters of negative GDP growth. So we have one quarter of negative. Now let's go to quarter three. If quarter three now GDP growth was 1%, that again is a 1% negative GDP growth, because we went from 2% growth in Q2 to 1% growth in Q3. So that would be the classic definition of a recession: two back-to-back quarters or two sequential quarters of negative GDP growth. And there are rumblings now. Okay, so take another step back. The first quarter of this year, we had negative GDP growth. So we already have one quarter in the bag of negative GDP growth. Q4 of last year was higher. GDP growth was higher than Q1 of this year. So we have one quarter of negative GDP growth in the bag. The fear is that now we won't know till July when they come out with the Q2 numbers. The fear is that right now we're in Q2 right now, quarter two. The fear is that we're going to see negative GDP growth from Q1 to Q2. We don't know yet. We won't know till July. If that happens, we are technically in a recession. Now, all of us know that inflation has been kicking all of our butts. It's been kicking the stock market's butt. It's been kicking everything's butt. So, from my perspective, I've been feeling like we've been in a recession anyway. And in a lot of different sectors and different industries in the U.S. economy, we're definitely in a recession. I mean, we have quarter over quarter, we have multiple quarters within certain sectors of negative revenue growth. So some actual industries are in a recession, but the U.S. economy, we won't know if we're actually in a true recession until July, when they come out with the growth of Q2 over Q1. So that's the definition of a recession.
Yeah, and for those of you all who are like, what does this really mean for me? Is the U.S. production is down, and then also it means that more than likely, if that occurs, you're going to see corporate earnings going down, which is going to affect. Oh, hold up, am I getting ahead or
no? You good.
Right. You're going to see corporate earnings going down. You're going to see less investment into new businesses, and new business ventures account for a large population of tax base for the U.S. Huge. And then because of that, you're also going to have companies that divest from some of the things they were doing. So that means they're going to be pulling money out. They're going to stop projects. If they were building a building, they may not finish the building, because inflation means that money costs more. If money costs more, then they're not building that building. You're talking about maybe 100 plus construction workers who aren't working. If 100 plus construction workers aren't working, 100 plus construction workers are going to think about that vacation before they go. And if they were all going to Disney World, then that means they're not going to Disney World. If they don't go to Disney World, that means Disney World doesn't get that revenue. If Disney World doesn't get the revenue, Disney World cannot hire as many people to work the concession stands. If Disney World has to then fire those people because they cannot afford them, that means that those people are going to go home and think about what groceries they really need. And then they're not going to buy the luxury items. It's going to, discretionary spending is just going to slow to a crawl. And people will start to buy only the things they need, which means that grocery store may say, you know what, we can't keep as many people employed as before. So now they let some more people go. So now they're claiming unemployment. That means that the U.S. economy is being strained because they're paying this. I mean, it's a massive chain reaction that, you know, sometimes people don't understand. Well, why does it matter? You know, like I feel like I've been in a recession anyway. I've been acting like it. No, you really haven't. And when gas prices hit, you know, $7 a gallon, and then eggs cost however much eggs cost per carton, depending on how you buy them, those things can start to make you change your mind. Even if you're wealthy, at some point you start thinking, is this just smart to do? Once all these factors are just floating around in the world, you're talking about, well, how quickly can we come out of recession? That's what people want to know. Like, how long will it last? This is going to be a very unique recession that more than likely we will go into, because we still have a huge semiconductor shortage. You have China on lockdown, which of course is happening because of COVID. You have a war in Russia and or Eastern Ukraine. Then you have lockdown, semiconductor. Oh, inflation at its highest rate since like 1994 or something. These conditions are unheard of for all of them to be happening at the same time, just literally unheard of. And I think CEO sentiment is like 60% that we're going towards inflation. And what that recession, I'm sorry. And then what that means that more than likely these CEOs are taking measures, preemptive measures, to reserve as much money now so they can make it through the recessionary environment, which kind of puts us closer towards the recession. So it's at this point, we're so close that if it didn't happen, I would be shocked. Like I mean, we're already, truthfully, in my mind, in it, but we're just waiting for the numbers in July to confirm to the world that we are in a recession.
Yeah, and a lot of so what you were saying about CEOs. So I don't know if you know people watching this or listening to this, if you're paying attention to the news as close as at least close I am. But so there have been a lot of layoffs, and a true telltale sign of a recession, or at least a coming recession, are layoffs, right? So there have been a lot of layoffs in technology, in crypto, and also in some retail, in some consumer discretionary areas like retail. And so those are a lot of times those are precursors to a recession happening. Now, like I said, we've already had 1 quarter of negative GDP growth, first quarter. these layoffs, I mean, they're not massive layoffs, because then, to put that in perspective, we still have 11 million jobs open in this country and only 5 million available workers. So there's still a huge amount of jobs open and not enough workers. So, but the problem with that is that creates what we call what's known as wage inflation. Everyone, I mean, I know, again, if y'all paying attention, but there's something out here called the Great Resignation. People are quitting their jobs left and right because they know they can go across the street and demand 30% higher in salary, and they're going to get it because everyone is short of staff. So that's causing wage inflation, which then is the companies then turn around and hiking the price of their goods. So that's leading to inflation. So kind of back to the recession thing, what Jerome Powell and the Fed are doing is, and they will never say this, they are actually trying to cause a recession. And the reason is remember, recession is negative GDP growth, right? So what does that mean? Like I said, GDP growth is determined by demand of products and services. The Fed is trying to shut down or cool demand by us, the consumer, to slow the economy, to cut down on inflation. So they'll never say it, but they're trying to cause a mild recession to cool demand, and that way we can slow all these ridiculous high prices. Problem with that can lead to job losses, which no one likes. There's an economist that was out today that said we probably right now we're at about 3.4% unemployment in this country, which is considered quote unquote full employment. There's a thought that we have to get that up to actually about 5% unemployment to really help bring wage inflation and therefore inflation down. So we probably will see a lot more layoffs coming in the next couple months. Definitely, probably by the end of the year. And it sucks. It's not a good thing. But in order to bring inflation down, it kind of has to happen. That we will see more layoffs. People probably will lose their jobs. But it's just demand right now for goods and services is just off the charts, and we've got to bring this down. And the Fed is doing it by raising rates, trying to tacitly induce a mild recession to slow inflation. So okay, we said all that about what inflation is. Now, how does it affect all of us? So one data point is that typically in recessions, when we have recessions, the stock market drops anywhere from 20 to 30%. But the interesting point is that typically when recession is coming on, the market will drop about 10%. And then once the recession hits, and then all the layoffs happen and all the the terrible headlines happen, then we get the other, say, 10 to 20%,
yeah,
drop during actually the recession. What's crazy is we've already, like, the market right now is down about 23%. So the market has already priced in a recession. So it's a double-edged sword, right? So one train of thinking is that we haven't hit a recession yet, technically, and we're already down 23%. The thought is that if we hit a recession and it becomes official, will the market then drop another 23% to kind of go with historical norms, or will the market say, okay, boom, we've dropped 23%, we're now officially in recession, now let's start to recover. So again, we won't know what will happen, once the data comes out. But what is known is that right now, if we go into recession, this is, as Brent said earlier, I mean, everything right now is unique. Where it's unique in that the market is down typically about what a recession, the market is down typically what a recession will cause, about 23%. But we've done it prior to an official recession. It typically happens a little before and during a recession. So we'll see. But all of us keep our fingers crossed that once we know if we're in a recession or not, hopefully not, but if we are in a recession, that hopefully can be some sort of bottom, or at least a temporary move of not going down, and maybe we can start to recover. But for us as investors, just know that typically recessions the market drops anywhere from 20 to 30%. Right now we're down about 23%, so we're right in the middle. So we could drop, going by historical norms, we could drop another 7%, or this could be it. We don't know, but just know that this pain that we're feeling is normal in recessionary times.
And also too, while you're in this space, and understand the market has been, I'm not gonna say artificially up, but the valuations on many of these tech stocks were ridiculous. Going into this, so the correction, personally, I think was needed. It hurts. It feels horrible. Again, Leon and I are in there with you, but this is one of those moments where we're giving you a list of things to not do. Okay, number one, don't freak out. So it sounds like simple, but you don't freak out. And when I say that, it just give yourself time to process what's happening in your household, with your accounts, whatever it might be. Just think before you react. The other piece is don't sell on the dip. Many of you are like, I'm out of here. This market is scaring me, and you're selling on the dip. And what's going to happen? Leon and I have been in this for a long time. Once you sell on the dip, you start to do what's called market timing. It's like watching somebody turn the rope in double dutch, and you're like, okay, I'm gonna jump in, but you never jump in at exactly the right time. So you end up buying, sometimes, in most cases, you end up buying far more at an appreciated price than if you would have just stayed. So if you can afford to, understand, we get it. Not the world isn't just made. Everybody in the world isn't made of money. If you can afford to hold quality companies, because we've been pruning since November, right? If you're an IA, you've been pruning since November. So hold quality companies. Also, you want to create a budget for yourself. Now is a great time to spend some days in the evening. You and your friends have a budget party. Do your spouse, whatever it may be. Just look at what your bills are, and then look at what your expenses are. If you need a budget, go to Investing Education Academy Facebook group. If you're listening to this podcast while you're running, driving, when you get to a safe place, go to Facebook and search Investing Education Academy and type in, I want a budget. We'll send you a worksheet to do. That can take you through how much you have coming in as income, how much is going out in expenses. Again, go to the Facebook group, type in "I want a budget," and we will send it to you through direct messenger. The other piece, make sure that the funds that you have available, some of which are in cash equivalent accounts. And we say cash equivalent accounts, you want to have some money that is readily available to you just in case of an emergency. And then the other one is prepare your mind. Prices are going to go up. Prices are going to go up. You don't have to spend a lot of time complaining about them. You can write into whomever you like to write into to say you want prices to go back down. But the reality is this market has to cool. And this economy needs to cool for a while. And the recession hopefully will cause that to happen. It's not all bad. Then also too, make this a time where you really assess your skill set. Is your skill one that's recession proof? Like we said, there's still a lot of jobs out there hiring. Some of those jobs, some of those startup companies that are looking for employees, they're not going to look for employees this like late this year, early next year is my thought. Some of the companies that really were ready to run, they will still be hiring. And they're still growing, they're still expanding. They're still going to want to hire if your skill set matches what they need to make more money. But they're not bringing people in just to feel good anymore. They're not filling positions that they think it just should be somebody there. They're going to be streamlining. They're going to be consultants that come in and trim the fat. So just make sure your skill set and what you do makes sense for your company. Be surgical about how you spend your money. If you're thinking, well, we're not in recession yet, so I'm about to go do this, I'm going to go do that, I'm doing all these things. Think about it. What would happen if most of you all lost your job? If the rule of thumb from the textbooks is if you're single, you should have, I think, 6 months worth of income or 6 months worth of bills in your account at any point in time in a cash equivalent account, which would be your checking savings accounts. If you are married, rule of thumb is you want to have about 3 months worth of income in an account, just because that's the way they wrote it. Personally, I like to have about 6 months worth of expenses in an account anywhere, like just that I can reach. I'm okay having it in the stock account. If I have it in my stock account, I'm probably gonna have about 8 months worth of expenses because you might have to liquidate in a dip. And then also, this is something that people don't talk about a lot. In a recession, it really is good to have cash on hand. And I mean, like, have a little bankroll somewhere in your house, because if you go somewhere or if you're doing something, emergency comes up, cash is king. And if you're able to, negotiate the price based off the fact that you have cash, depending on where you go to buy something, farmer's market, some of these stores, if you're still shopping, you can negotiate price with cash. So have a little cash on hand. In addition to that, if emergency comes up and systems are down or anything's going on, a worker shortage somewhere that causes systems to be down, you don't want to have all your assets tied up into digital currencies. And now you can't get access at the gas pump. And you really need gas. So have a little bit of cash. The kids need, or you need food, but the computers are down for some reason and you have no cash. I mean, it can be a problem. You can be a millionaire in your bank account, but you have no cash in your pocket. So the person with $20, they're gonna look more important than you.
Yep.
And so just I'm not saying carry 3, 4, 5, 6 months worth of cash in your safe at your house, but have some cash to change your situation.
I just add to that real quick. Mm-hmm. Your debt. We talked about this before. If you can start paying down your debt quicker, you want to do that as much as you can, because the Fed rates are going to continue to go higher. So the Federal Reserve is going to raise rates this year. They're going to raise at least 2 or 3 more times. Just to give an example, right now, so the rate that they watch is called the Fed funds rate. Just doesn't matter what it is. Just understand the numbers. So right now that rate is at 1.75%.
Yeah, no, hold up. The Fed funds rate is the rate by which the Fed loans out money.
Yeah. Yes. Okay. What Brent said. Yes.
It's the rate by which the Fed loans out money to.
But it's like, how does that affect the normal person? I didn't want to go down
because the normal person will go to the basically whoever gets the money firsthand, then increases they pass on that increase to the consumers like when you're loan, they give loans for your houses or anything else. They pass that raise on to you plus some. So
they basically pad it. Yeah, they put a little profit margin on it. So right now that rate is at 1.75%. The Federal Reserve's target by the end of this year is 3.5% for that rate, which, as Brent said, that rate affects everything in the economy, right? So your credit card, so if right now you're paying, your credit card is paying 1.75% plus whatever the credit card company pads it at. By the end of this year, that's going to be up to almost 3.5% plus whatever the credit card pads it at. So if you're paying 19% now, by the end of the year, you could be paying 25, 26, 27% on a credit card. So rate and also the Fed is not going to stop raising rates this year. That 3.5% target by the end of this year. Next year, I think their target for the rate is right around 4%. So it may go up another 0.5% by the end of next year. So saying all that to say, pay attention to your debt too. If you can start paying down your debt faster, if you have to, if you can, if your normal cadence is all you can do, that's all you can do. But if you can start paying it down more, putting more money towards your debt now before these rates really start to skyrocket, definitely do that, because they will save you, tens or hundreds of dollars per month over the next year or so.
And this is a go back to, I hope you all are listening to these lives, and it's not because it's Leon and I, but it might have been early 2021, maybe 2020. We specifically said if you have equity in the house or anything like that, you might want to take out a loan against the equity line that's fixed rate. And don't forget, when you do that, you don't have to use it. Like, you just have access to it. If you would have done that, your rate probably would be 100% lower than what it is today. Like 100% lower. And, for some of you all, you did it. Some of them you didn't. Maybe you all think, well, I listen to you all, but I don't really listen to you all.
and just real quick, to put an example of what Brent just said, last year about this time, rates were about 3%. Mortgage rates were about 3% for a 30-year fixed mortgage a year ago. Today, rates are about 6.25%, pushing 6.5%. So like Brent said, they're up over about 100% gain or increase in mortgage rates over the last year. So, and this goes back to what I was saying, what I just said. Had people started addressing their debt earlier, taking out a loan at that time would have saved yourself a lot of money. We're saying the same thing now. If you can start addressing your debt now, because a year from now, rates are going to be a lot higher. So you can save yourself a lot of money right now by addressing your debt. If you can, again, if you can't, you can't. But I was just making another point. You notice we're not going really deep in like the stock market and what to do and what not to do. This market, as I said from jump, the point of this market is to lose the least, not even really try to make money, right? Like this has been going on. We're going 8 months of a bear market, and all of our accounts are down. Unless you, okay, can't say all. Most accounts are down right now, and they'll probably continue to flutter to go down over the next couple months. This market is not a market to try to be a hero. It's not to try to be a stock picker. It's not try to be, to show how good you are. It's meant to break even or lose a little bit. Gaining is only, that you're a superhero right now in this market if you're gaining. So that's why we're not really going too deep into the market itself, because there's nothing really to do in this market right now. This market is either sit on cash or dollar cost averaging as it continues to drop. But we're not looking to make really any money in this market right now. We're trying to preserve capital, preserve our sanity until this whole craziness is over. So that's why we're talking about some other things versus just what to do in the market.
Yeah, and also too, kind of to Leon's point, you have to get ready for amazing buy opportunities.
There's some right now. If your dollar cost average in, some right now. But yes.
You have to be ready, and that means like not feeling like you have to pounce. And this is where you see the side of me that's more calculated. Because normally I'm like, oh, let's drop a bag on it and let's just ride, see what's going to happen. No, this is when you have to look at the financials of these companies. You have to look at how much money you have. You have to look at your time horizon to be an investor. And then also, you have to leave a little to the side. This is the market where you really, if you're going to go in, I would suggest dollar cost averaging right now. But also, if you're looking at, these are great buys, they may go a little lower when it's official recession that we hit. If we hit an official recession, we're probably going to hit official recession. But also too, you really just don't know what will happen. This is a great time to start doing some family planning. If you don't have a will, if you don't have an estate plan, if you don't know who, like, what if something happened to your dad or your mom, who would that account go to? Because maybe you might need the money if something really does happen to them. You know, this is a great opportunity to step back and just look at your financial picture, the money of it, not just the investments, and just say, what are we spending our money on a regular basis? Like, why are we getting with Krispy Kreme every Friday and spending $50 there? Why are we going out to eat every single day when we don't have 6 months worth of bills stacked up? You know, maybe I'm not going to buy that new car because the one I have really is fine, and I don't even have an investment account. Like, this is a great opportunity. We've had people calling us asking, okay, I'm ready to get in now. And you would think this is the time people run away from the market, but no, there's some people are running towards it because they know at the end of this is going to be some serious rainbows and major wealth is going to be made. It's just, maybe you'll listen to this live and say, you know what, I'm going to do something. Maybe you'll listen to this live and go, oh, it's cool listening to them.
But I will say, yeah, on that point, I will say that just to make the point, draw the point home, recession risk is very, very real now. What the Federal Reserve is doing by raising 75 basis points last month showed how serious showed how serious inflation is, and showed how serious they are about getting it under control, and they're willing to cause a recession to do that. So because they're mandated, the Fed has a dual mandate: one, price stability, which means no inflation or relatively low inflation, and full employment. We have full employment right now. We're at about 3% unemployment. That's considered full employment. Price stability, that it's out of control. So they're trying to get their mandate. They're trying to really adhere by their mandate to getting it back under control. So the next rate hike next month is most likely going to be another 3/4 of 1% raise, which is going to shoot rates up even more. And then they're talking about doing a 50% or half of 1% raise in September. So this thing is just going to snowball, people. It's basically what I'm trying to say. Rates are going a lot higher. So if you can, again, address some of your debt now, start paying things down quicker if you can. I would say definitely do that, because, again, the mortgage rate example was a perfect one Brent brought up. Last year, mortgage rates were half what they are today. And next year, at this time, rates will probably be 30, 40, 50% higher than they are now. So we want to start addressing these things now if we can.
And Leon, just to touch on this, we talked to one of IA members who is, I mean, he's extremely experienced in the real estate marketplace, and he's a realtor. This guy's been written up in the Washington Post about his accolades and selling real estate and so forth. And so the question was, what do you think about rates and what's happening in the real estate market? He said, I don't see any difference between this and any other time in history. And it was a shock to me. I was like, what are you talking about? These rates are horrible. He said, man, I've been selling real estate so long. I remember when Reagan was in office, to buy a house, the interest rate was 16%.
Yeah, in the 80s.
16%. So to give you some perspective, if your mortgage is, let's say, is $3,000 and you're at like 6%, if it's 16%, your mortgage might be somewhere close to like $7,000. Like, that's huge. That is a huge difference.
Mm-hmm.
And so for some of you all who are thinking like, well, what does that even mean? That's what it means. And he kept saying, you know, people were buying then, they're going to keep buying now. And he said his statement to his customers or the people buying houses has always been the same. If you like it, get it, because real estate prices aren't going anywhere. And the reality is, you're better to own it. And if you have to sell it later, sell it. But if you have to, you always have the option to refinance at some point in time. And so, you know, for those of you all, I'm just sharing that conversation. It's not even my thoughts, it's his thoughts. But I don't want you all to feel like you can't do anything in this market. Like, there's no opportunities out there. There are. And, you know, as we find them and things come up, we'll be sure to let you all know. But it is definitely that time to start thinking about how you spend.
Yep. So that's pretty much all we got today. Again, this was more about recession.
Hold up, Leon. One thing. Everybody, Leon said this about 2 weeks ago, and no one contacted us about it. It kind of bothered me, but he said call and check on the interest rate on your credit cards.
Oh yeah.
I don't know how many of you all did this, but that is a very important thing to do right now, because at the very least, you can start setting some benchmarks as to what your interest rates are, so you can know which cars to pay off first.
Right.
It is not always the car with the highest balance. You have to look at the interest rates. And if you don't know the interest rates, how will you know which ones to start targeting first? You want to get rid of consumer debt as quickly as possible in this environment, because as they change rates, these credit card companies are changing their rates, because many of our cards are variable rates. They are not fixed rates, and you will not pay any attention to it. You'll just keep paying this minimum because it's what you've always done. And you'll realize all of a sudden, when you're old and gray, your kids now are going to be responsible for these debts that you had because you never took care of it.
Yeah, and I think also, like you said, a benchmark. If you look at it now and say, okay, your rate is 23%, and then you look at 6 months, a year from now, and now your rate is 29%, you'll actually see, wow, like that was a huge increase in my rate. I'm glad I actually did something about it early to cut down on those costs, that these future costs that you could have incurred. So yeah, rates are going a lot higher. It's not the Fed is not stopping anytime soon. So again, address your we do have a recession most likely coming. We don't know when. We'll know in July if it's already started. But the pace which the Fed is raising is probably going to induce a recession. Hopefully a mild one. Nothing like 2008. We've had some mild ones in the past where they may last a quarter or two, or maybe even a couple months. But just be prepared for that. That is coming. And again, the stock market, where most of us play, it's at a recessionary level right now. It's already down 23%. Typically, recessions are down 20 to 20. In recessions, the market's down 20 to 30%. So we're in that now. So that's also another good reason to maybe start nibbling if you're not. Start buying some small positions, dollar cost averaging in, because we're at recessionary levels already. So I know I've been doing that. So.
Yep. Well, everybody, we thank you for being with us. We owe you two things, and those are our stock picks. You can log into the private IA membership platform at www.iamembers.com to see both picks. If you'd like to see just one of them, you can go over to Investing Education Academy on Facebook and become a member if you're not already a member of the group. We're 400 plus, so it's definitely a good community over there, and we're growing. So we hope to see you over there. And for everybody, thank you for continuing to support us. We will be with you throughout the possible pending recession. So don't think we're going to jump under a rock and hide. We're going to face this head on.
We are here.
Yeah. Have a good day, everybody.